Somil, if it makes sense, would you mind talking a little bit about just a recap of the different types of risk capacity providers, like insurers, reinsurers, et cetera?
Yeah, I think that's a fantastic topic because we talk about this very nebulous concept of risk capacity, but do a terrible job actually identifying it, defining it, and specifying who the players are. So let's talk about that. First of all, here's what risk capacity means. Every time you write a policy, if as an MG, as a carrier, doesn't really matter. Every time you write a policy, let's say you're taking $1,000 in premium, you have the potential typically of a loss that's much greater than that $1,000, right? So if it's my auto policy and my limits are, let's say, $50,000, I could have a loss day one that costs $50,000 to the company, and my insurance company needs to have that money sitting around to be able to pay. Now, not everybody is going to have a loss of $50,000 on day one, so it works out in aggregate, but they need to have enough capacity, and that's really what it means here, so that they can be able to write that premium and the regulators feel comfortable allowing companies to kind of offer this future promise of being able to, settle claims. So that's the idea of capacity. And there are typically a combination of insurers and reinsurers that collectively provide this capacity. And really what that means is that they have a huge, some typically hundreds of millions of dollars of money sitting around in a bank somewhere in a trusted account, so that the regulators are comfortable that in the case of an event, they have the ability that they can release that capital.